Hey guys, I'm Matt, and welcome back to the third episode of the podcast. Today, we're going to be talking about how to read a company's earnings statements that come out 4 times a year and what they mean for the stock price in the future. Apologies for not posting recently. I've had computer problems that I just worked out, and I got a new mic from a friend, so hopefully the quality is looking better. Let me know down in the comments, and today's a good episode, so stay tuned. All right, so let's dive right into it. So, when you look at a company, they release their earnings 4 times per year, and analysts expect how much revenue and profits they should earn, and that's what the public uses to reflect in their stock price. So, if you want to find the which companies are reporting earnings based on the actual day, you go to Yahoo Finance, Markets, calendars, and right here you could see all the major events in the stock market, so earnings, stock splits, IPOs, etc. If you look at today, August 6th, when I'm recording, you could see all the companies that are going to report their earnings either after the market or before the market opens. And usually the stock price goes up or down a tremendous amount, being 5 to 10% about on average, based on if they do better than the analysts expect or worse than the analysts expect. All right, now let's dive into an actual example. So the one that I found is Beyond Meat, ticker BYND, and pretty much what they do is they make plant-based alternatives to hamburgers and hot dogs for vegetarians and vegans. So they just released their earnings this past week, actually on Wednesday or Tuesday, sorry. And here you could see it in the stock price. They didn't beat the analyst expectations in terms of profit, but they beat the revenue expectations. So how revenue is tied into earnings, it's revenues minus expenses are the actual earnings themselves. And analysts expect how much revenue the company will make, as well as the actual profits that the company will make. So right here, if you look, they had a net sales of 113.3 million versus the estimate of 99, and they had the same earnings per share as expected. But the stock still went down, even though they beat the actual amount of sales, because of something called guidance. And guidance is how the company expects to do for the future. So let's say you're a company like Apple and you're releasing a new iPhone. The quarter before, when you release your earnings, you're going to say, oh, we think the iPhone is going to really bring our earnings up for the future quarters. And once the public hears that, they have a reaction and they decide whether or not they want to be in the stock for the next quarter. So in this case, Beyond Meat beat the actual net sales, but they didn't beat the earnings part. And their guidance was I guess you want to say. And as a result, the stock dropped from 142 to 131. Their next earnings are between October 26th and October 30th, which is a quarter of a year from now, about 3 months. All right, so another example I could give of how a company's earnings affects their stock price is in the company Fastly, ticker FSLY, and despite them having good earnings, the company is still down 18% because TikTok, their major revenue component, this is about to either be shut down by the Trump administration or bought out by Microsoft, but the chance of them shutting down would be a tremendous revenue hit to this company. So as well, although they beat the earnings expectations by analysts, the public did not like the fact that their biggest source of money, I guess, is being or has a chance of shutting down. So the stock is down 18% today, from about $110 to $88. Really not good news. All right, so for the last segment of this episode, I wanted to talk about Apple, a company that did earnings very well with strong guidance, and show you guys that not only do stocks have the option to go down, but also the ability to go up if they do well. So if you look right here about when they posted their earnings, they were about $4.10 a share. They posted their earnings, good guidance, good revenue, good earnings, everything. And they actually shot up to about $440 a share, proving that if you own good companies that you think will do better than the analysts expect, there's a lot of potential to make a lot of money in the stock market. So that's all I really had for this episode. Thank you guys for listening. Just know that trading around earnings isn't necessarily the best idea, but it is a strategy that some people do take to try making as much money as possible. But other than that, I really hope you guys enjoyed this episode. If you have any comments, questions, concerns, feedback, anything for me, please leave it in the comments. Hopefully you guys enjoyed the quality with the new mic. And yeah, I will see you guys in the next episode. Thank you.